So very good afternoon to all of you. And once again, to those of you who have joined us, thank you so much for joining us. And this is our FinPaha webinar series. I myself am Deshani Ratnayake, Vice President of Corporate Finance and Advisory at First Capital. So what is FinPaha? FinPaha is really more than a statement. It is a movement to empower women through financial wisdom. We are doing this in conjunction with International Women's Day and Women's History Month to champion women's financial empowerment for the second consecutive year. In this series, we will focus on financial challenges and the journey to financial independence, particularly within Sri Lanka. During the course of the afternoon, just to take you through what lies ahead, we will be going through an insightful presentation that will cover 3 key steps that you can follow to get better at investing and hopefully launch out into your investment journey. Subsequently, we will be followed by an enriching panel discussion featuring industry experts, 2 ladies who will be here with us this afternoon, Rashmi Peiris Paranavitane, CFA, President of the CFA Society Sri Lanka, and Inoshini Perera, Director of Strategic Planning at Verité Research. We truly hope you will find this afternoon insightful and from this point on, really learn a few extra things that maybe you didn't know. We are hoping to kickstart your investment journey. So if I were to just take you through what we have for you this afternoon, a little background as to who we are. First Capital, 40 years, leading the way in debt and equity advisory, in primary leadership, equities, and also asset management. We have 170 billion rupees in assets under management, and between management leadership experience of over 200 years. We are a part of the Janashakti Group and were recently recognized with one of the most prestigious titles in the industry and brand of the year by the Sri Lanka Institute of Marketing. That's just a little bit about us. And moving on. So why are we doing this? Why did we see the need to sort of run this webinar series on this particular topic in specific? So a few things that we face as women, day in, day out, when it comes to managing finances, when it comes to what to do with the funds, few of these thoughts may have, I don't know, some of it has definitely run through my mind, and I'm guessing it must be the same for you too. Few things like you want to do a lot of things, but the incomes and expenses are sort of just matching up, and there isn't really extra to do much. And so you're limited in really what you want to do, whether it be, saving up or investing, or even investing in something that you truly want to aspire to have. For instance, a house, it could be a vehicle, it could be something that you just want to acquire for yourself, right? Another one is scared of losing money. I mean, sometimes we are all very careful with what we do with our funds, and sometimes that makes us move on to a more extreme end of risk aversion, and we're scared of losing money, right? And so that's a very natural thought, and I'm sure that has crossed through your mind as well. And when even planning for children, so many things that as parents or even somebody in your family you want to plan for, education and different milestones in life, which you really don't know if you're going to make the cut, right? And so, are you doing enough? What can I do better? How could I sort of, expand the finances I have? These are all thoughts that have inspired this session today. And stemming from what we just looked at, you might even feel that investing is a scary experience, or am I too far off? Like, am I ready for it? Can I even do it with what I have today, right? And you might really think that investing is not for you simply for the reasons that we spoke of. And so we're going to look a little bit, before we go into anything else, of the current landscape in Sri Lanka when it comes to financial literacy, financial empowerment, and really set the stage to what we are looking at today. Okay. So a little bit of research, right, shows us that about 90% of women have savings accounts. But women, we are more akin or more aligned to investing in safer instruments, something a little more traditional, okay, rather than active investment. And we're going to look a little bit of what that looks like later on, but this is just some initial data for all of you who have joined us today, right? We see that 35% of women are there in the workforce, right? Which is fairly low, right? Men seem to have higher financial knowledge and shows better signs of financial behavior scores when compared with women. Overall financial literacy rate in Sri Lanka is at 58%. So there's obviously room for improvement. These stats are based on the National Financial Inclusion Strategy and UN Women Strategy of 2022 and some statistics from the Central Bank of Sri Lanka. And a few misbeliefs that, you know, we all have to sometimes we hear, we experience. It's sort of embedded in the grain of being Sri Lankan sometimes. So, you know, it's the fact that sometimes one thing is that men are sort of make the more of the financial decisions. The decision making of what happens with funds can sometimes lend towards male dominance, right? The other thing is maybe as women we shy away because maybe we feel that investing is too technical, you know, so much jargon, so many things to watch. I don't have the time. You know, or maybe I don't have the know-how. I wish I had more data that would help me in this purpose. The other thing is that investing is too risky. And if I invest, I'm definitely not going to get my money back, right? And so you're scared to lose your funds and the risk aversion kicks in. The other one, which is probably more of the, you know, the one that's very more common and maybe unspoken, but definitely is definitely something that is that exists, is the fact that you consider savings investment. But today we're going to look at how that is not the case, and how those two are two different things and lead to completely different results. Okay, so when we talk about, you know, I wish I knew more, had more information, or I wish I was equipped better, right? Some of our, the lack of awareness that we have towards investing can come because, you know, maybe our knowledge on basic macroeconomic principles is not so heavy, or we feel it's technical, or we don't really understand how that works. We don't know what to look for. Okay, and the other thing is knowledge about investing. What do I invest in? Where do I start? How do I go about it? Which is the better of the options for me? You know, are some of the questions that you might have, and as a result, because of the lack of answers, not really move forward. And so today we want to bring 3 simple things to you. You know, very simple. Let's keep it simple. And, you know, and I'm sure these 3 things will really propel you in the right direction to do to have a better investment journey, right? The first thing is understand the basics and get advice. Okay. And we're going to look at each of these things as we move along. Know what to look at. Whom do I talk to? Right? What information do I need? You know, those are some of the things that are sort of relevant there. And start with what you have. You know, the important thing is to be able to start today with whatever is available to you, as opposed to set another milestone to one day hopefully have enough to invest. But it really doesn't have to be like that. The other is be consistent and monitor. Okay, when we talk about understand the basics, we are talking about understanding a few things. You don't have to be an economic expert, but just know a few key things that are relevant to you having to make an investment, or know what really makes the move for you. Okay, so things like interest rates, where is it headed? You know, inflation, where is that headed, and how does that impact interest rates? And when inflation and when interest rates are high, what are the investments that are suitable? So the investments that are suitable when interest rates are high are different to what is relevant or suitable when interest rates are low. So when you are able to understand the current dynamics, you are able to even with basic knowledge, be able to sort of look in the right places and look for the right things. Okay. So for instance, so this is sort of the next slide will sort of add more color as to what we are referring to. So for instance, if we look at a high sort of when inflation is slightly on the higher tick, okay, we will see that rates increase. And in those particular instances, investments in government securities, unit trust funds make more sense. And you will see that shift happening. On the other hand, when inflation is low, when interest rates are coming down, there is a tendency to move to the stock market. Okay. And to sort of add color and add more flavor to this with real information, we'd like to just draw your attention to this particular slide, which shows you a historical movement of how inflation has moved versus interest rates. Here you have the one-year treasury bill, which is your government security risk-free rate, which is the main indicator of interest rates. And you have your ASPI, which is your stock, your equity index. So you will see how how inflation has moved, the other two have moved differently. You will see that when inflation drops, meaning interest rates are dropping, you will see a move into the stock market, right? For instance, if you look at the bottom, August 2022, Treasury bill rates were at its highest, 29.5. Okay, inflation was also at an all-time high. And you will see that the ASPI was at its lowest, which is the indicator of equity index, right? You will see that it was at its lowest. Whereas in Jan 2025, we saw a drastic reduction in interest rates, and you see inflation negative and the ASPI at an all-time high. So that's just sort of to give you an understanding of how all of these work and really what you should be looking at. Okay, and to the point we spoke of, savings versus investment. So let's look at something traditional, okay, which gives you an interest rate of 3%, right, which is more a savings sort of instrument, and where you save 10,000 every month. In a year, do the math, you will have a return of 1,967 rupees versus investing in a unit trust fund, which gives you an attractive return, and where you invest in 10,000 every month, and in a year, your return is 3.5 times higher. Okay, this is obviously using the interest rates at this particular period of time, and these will vary as and when you are the period that you are computing for. So you will see a difference in returns, and this is what we'd like to highlight when we talk about when we say savings is not investment, and that's why we are trying. We want today to speak about the investment mindset. Okay, when it comes to being consistent and monitoring, it's important that you have access to information on a consistent basis, right? Because you will be wanting to know the value of your investment on a frequent basis, on a regular basis. And so it's important that you tap into the right channels and are provided with the relevant information. Having a platform which can help you see the value of your investment every day on a real-time basis is something that really adds value as well. So we have our WhatsApp channel, which you can be a part of. The link to that will be provided in the chat on this on Zoom, and you can be a part of it. So that gives you access to market information and daily updates. The platform that we have is our First Capital portal, our investment portal, and that will help you see how what the value of your investment is. You can make your investments and to make changes as well. And on a consistent basis, we have forums that give you access to useful data on stocks, on the market, just knowledge sharing forums that we have on mid-year, annually, and from time to time, which you can be a part of. And as and when those arise, you will also be informed. So how can you start? Okay, so the first place is any funds that you have. A good place to start is a unit trust fund. Okay, this is a pool fund where it's backed by fixed income assets, from banks and finance companies, and a range of other investment assets. And those are analyzed, and the risk profile is also managed on that, which gives you the opportunity to invest any funds that you would have, whatever you have today. And if you'd like to look at diversification and sort of planning your wealth and not really putting it in one investment option, and you have a reasonable sum that you'd like to use for this purpose, you can look at diversifying it into multiple options that would make sense for you. You can speak with our team, and they will help you plan your funds accordingly, looking at what you need to be kept as liquid, what can be a little more long term, and what can sort of tie in with your requirement over time. Should you have a requirement for children's savings, for investments and saving up for your children, for minors, we have a unit trust fund for minors, where if you put in a regular sum of funds, those will also grow over time and be able to really be at a decent amount for you to be able to use it for education or whatever else that you have plans for. With that, we would like to move into the panel discussion. I hope you found the last few minutes of this of the presentation useful. And so to join me in the next session of our panel discussion is Rashmi Peiris Paranavitane, President of the CFA Society Sri Lanka, and Inoshini Perera, Director Strategic Planning at Verité Research. Just a little bit into the two distinguished ladies who will join me here today. So just to give you a background of Rashmi, Rashmi is a leading finance professional with over 18 years of experience in investment research, financial analysis, and consulting. She has been working with global firms such as Tax and Moody's Analytics Knowledge Services. She's held multiple roles within the CFA Society Sri Lanka as a board member and on multiple committees, as well as chair of the ESG committee. She currently serves as the president of the CFA Society Sri Lanka. In these roles, Rashmi's aim is to drive the society's efforts to promote sustainability and champion best practice in the Sri Lankan capital markets. She is a CFA charter holder and has a Bachelor of Science in Business Administration from the University of Sri Jayawardhanapura. With me here also today is Inoshini Perera, who brings a blend of international experience from the UK and Singapore, complemented by local expertise. She holds a master's in finance from the University of Cambridge, UK, and a Bachelor of Science in economics with first-class honours from the London School of Economics and Political Science, UK. Her career spans various specialties, including investment banking, management consultancy, and corporate banking. She has held various roles as Vice President in Mergers and Acquisitions Advisory at Bank of America in the UK, Associate Director at KPMG in Singapore, and several senior positions at Standard Chartered Bank in Sri Lanka. She currently serves as Director Strategic Planning at Verité Research. Thank you so much, Rashmi and Inoshini, for joining us here this afternoon. And thank you for taking the time. Just to sort of kick things off a little bit, and maybe I'd just throw this question, and maybe whoever feels free can take a stab at it, right? My first question is, how do you see the state of female financial empowerment in Sri Lanka today, if you take today's current context, right? Do you think things are moving in the right direction? And could you tell us a little more about the state of financial awareness and how that can impact, or what that would really translate into?
Maybe I can take a stab at it. I'm sure Inoshini probably has a lot more of a research angle on this, so I'm interested to hear her views as well. But from a more, if you look at our economy, female empowerment, if you take overall female empowerment, it's about having agency. I hope I'm audible to everyone. Okay. And within that, financial empowerment plays such a key role, but I think it's also one where we probably don't give it due importance. When we think of female empowerment, we think about, labor force participation, to having the freedoms to work where we want, or having access to education. But the financial empowerment is such a crucial part of overall empowerment. And I think it's not just the ability that we as women have to make decisions, but also the confidence to make decisions that I think will promote our long-term financial stability and well-being. I think I'll maybe talk a little bit about the financial awareness. I'm sure Inoshini can add more about the empowerment aspect. But if you look at the financial awareness, as a country, I think overall our financial literacy is quite low. But particularly among women, it's estimated to be even higher. As in that our financial literacy is even lower than, if you look at overall financial literacy. And that's a pretty bad trend, because our literacy rate is high, considered as quite high, but our financial literacy rate is estimated to be only about 35%. That's quite a big gap, and that compares to an average of about 50% or so in a lot of regional peer countries. Why I think this impacts even the overall economy? If you look at it at a more micro level view, women are often key decision makers when it comes to their home economies. They are the ones who will decide what food is on the table, how much is spent on education, and in a lot of instances, they may be the primary breadwinner. But I don't think we have been empowered to make informed choices on our spending, on our budgeting, on our investing. And then more often than not, women are also, having a more paycheck to paycheck existence, and relying on the informal financial sector for their financial needs, which is not a good, trend for the economy. And then if you look at a more macro level, in a lot of industries, even where women are quite heavily represented, if you take apparel or if you take tea, even in sectors where women are employed in more professional capacities, even then I don't think we have empowered women to be more effective in their, saving, investing, which I think is a missed opportunity. So I think the other thing is that women also play a very important role in how they influence, their families, the next generation, in our roles as, say, parents or teachers. So if you educate women about how to make better informed decisions about their financial, decisions, and how they invest, you're not just helping their financial security, but you're also, effectively helping them to educate the next generation through that trickle down effect in their communities. So I think, given those reasons, I think it's quite, important that we place a lot of, focus on educating and making women able to make these informed decisions when it comes to their savings and investing.
But really, what you said is so true. I think it's not just as women how we make these decisions, but really how that impacts and trickles down to every other sector. Even if you look at the next generation and just the very, even it's an organization, a small business even, and the impact it has on that, right? In terms of my next question, is more looking at sort of the flip side to this, right? And as challenges and barriers, what do you think holds women back from making financial decisions, right? Now, I know there's a lot at play here, but is it more culture? Do you think it's economic, or personal, or just personal challenges, or maybe a combination of the two? Something that we can, what do you think?
Yeah, I think you also talked about it in your previous remarks as well. I think there are a lot of it could be cultural, it could be personal circumstances, etc. Our education system also doesn't really, you know, place a lot of emphasis on educating us on. They may touch on, say, saving, but there's hardly anything that we really touch on investing. And I think that should also not be just something, say, you teach, for instance, if the students are studying, say, commerce or finance. I mean, these are basic skills we need to impart on almost every single student while they are in school, when they go to university, regardless of what discipline or field that they study in, because it has such a bearing on their, financial well-being, and making sure that they are able to thrive in their, whatever chosen field. So I think because of those reasons, I think those are some of the challenges and barriers. But I also feel there are other forces at play. Sometimes it could be due to not having the right access, not lack of access, but maybe not really being aware of how to access. Again, it could be lack of knowledge on how to get about it or how to start that. um, but I think with women, I feel there really hasn't been a strong why. For a lot of women, I would argue that it more than any other, even if there were barriers at play, uh, for women, if there has been a compelling why that has been really, imprinted on, this is why you need to invest, then I think women always find a way to overcome a lot of the barriers that are thrown in front of them. Uh, I mean, for women to do anything, whether it's to work, whether it's to build, passive income streams, acquire a skill set, there has to be a compelling why. Just as an example, during the pandemic, when a lot of households were going through, uh, really challenging economic conditions, a lot of women started, home businesses to supplement their home, income. But that was triggered by a necessity. So if you look at the other side of it, why people who do invest, it's because they want a better return, and they want to build wealth and have a more secure financial future. Uh, so I think one of the big reasons why women don't invest is the reasons that women say they don't invest, that it's too risky, or they lack the knowledge and skills, that they don't have enough time, or they don't have enough money to get started. I think those reasons at the moment are not able to, or rather, there's not enough of a compelling why, that you want a better return and build up that financial security, is not a compelling enough why to offset those other barriers. But I think if women really understood this why, it's such an important, I mean, it's an existential threat almost, or that this effectively is the difference between having a secure future and, your family's, your own financial security, versus not having that freedom. If women really understood that, and we enable women to understand the differences in the right approach or making the right decisions, whether you are 25 or 30 or 40, on the kind of life you can lead at 60 or 65, then I think women will act and invest very differently. Then I don't think those, barriers, etc., will really come into play, because then they have the knowledge and the means to really make those decisions for themselves. So I think, I mean, I would argue that if you equip with them the right knowledge and awareness, then I think that will happen over time. That's my personal view.
Correct. That's right. And even if you look at even some, I mean, some very simple example, even our own educational system doesn't even talk about investing, or even,
It really
on
doesn't.
it doesn't, right? So from a very young age, it's not drilled into us, even as a
Yeah.
life skill. It's introduced very late in life. And so,
Yeah.
those are also some of the things. Both of you, about your journey and how it has been, how you have become financially aware, what you have done to achieve financial independence. What are few of the things that you can tell the audience here who's with us today? Give them a little bit of insight into that journey and how that has been for you, and maybe break it down into maybe life cycle. I'm sure you've gone through different seasons, and how that sort of the financial journey has evolved with that as well. So maybe Rashmi, I'll put that to you for the start.
Yes. So I think just my own personal journey, and I think if looking at also the phases of life, my own journey has been, I would say, very self-taught. Um, and I think that's true for most people, even those of us who've studied finance or done accounting or done CFA. Um, and I'm sure Deshani, you can relate as well. Just because you have done these qualifications or work in these fields or in these roles doesn't automatically translate that you're going to master all of this in your own personal life. And I'm
So
pretty sure
true.
that a lot of people can relate to that. Most of us grew up in environments where our parents weren't exposed to investing. I hope I'm audible, right? I'm not breaking up. They were raised also to be, I think, quite risk averse, opt for safer choices. I'm sure the twists and turns that our country has taken in the last 60 years, 70 years also didn't help, from the war to various economic crises. Um, so I think a lot of our parents and the previous generations adopted a more risk averse mindset, which I think also influenced us to some degree. But I think we really have to challenge that mindset, and I think that's what I did for myself. I too started with very small basic steps at the beginning in my early 20s. It was purely about financial independence. I started working when I was 21. I was still in university. Wasn't easy to juggle, but financial independence overweighed every other um, concern, and not depending on my parents and having that financial freedom was far more important than even getting qualified. But from that point on, it has been a more gradual journey. In the early part of my career, I wasn't really saving that much. I was mostly investing into myself. So whatever I was earning actually went to fund my education, whether it was CFA at the time. And I think that's quite okay. The investment in the early part of your career can even be in yourself, and that investment will pay off in the long run. Um, and then as I moved up in my career, and then uh, life started to also evolve. We started building a family again. There was a point of time where I wanted to re-examine a lot of choices, my work-life balance, financial security. I took a break, a short break, after having my first kid. And then the next 10 years, it was really more about, now that I had kind of worked, and to really look at how I could build up my finances and move more towards investing. And one thing we really did at that time, so this is more like early 30s, uh, really re-examined our debt position. We had made some borrowings, and we just wanted to make sure it was completely manageable. So for a couple of years, we were very disciplined, and we gave up certain things, but I'm really happy we did that. I personally was never really drawn to luxury items, so that luxury items that don't really have much functional utility or investment value. And I think this is something I feel Sri Lankans don't do well. Sri Lankans, I feel, get attracted to shiny objects, whether it's luxury cars that are beyond our current means, and then you borrow to afford these, and then you end up compromising your financial future. So I would say, just now as I'm entering kind of another phase, it's really been at each of those milestones, just reevaluating your current financial situation, um, looking at our investment goals, and then making whatever adjustments that are necessary. And because I think this is why a lot of people struggle, is because it's not something you can just leave and forget about. And it's something you have to keep revisiting, always reassessing your current finances, your current financial situation, how much you're spending every month, how much you're you know earning, how much you're saving, in the context of how is the economy doing, what are the more attractive. That is, I think, hard for a lot of people if it's not ingrained into you as a kid when you were growing up, that this is just something you have to manage alongside your health, your kids, your education. It's a lot of things that we juggle, right? Particularly women, there's so much of a mental load that you carry, making sure your kids are fed, making sure kids go to school, to meal planning, to your day job, which is again a full-time job, and so many things, and then to your taxes, to there really is a whole lot of things that pile up as we get older. So this sometimes for most people is just something that we kind of leave as a by the way thing, we're not very proactive, and it has dire consequences as a result of not being taking ownership of that, because this, especially as women, I think it's just not one of those things we can leave to chance and be passive about. So that I would say, and I actually didn't do that. I really, in the next segment, I think I'll talk about even some of the things I did wrong. But this particular aspect I did do for myself, where I didn't go along with whatever I was taught, or experience in my family growing up in that more risk averse kind of mindset, um, and just took a step back and did what I thought was more, you know, um, but at least that part I can say I did. Yeah.
Thank you, Rashmi. Inoshini, any insights you might have into your journey of financial empowerment and what that kind of looked like for you? Any key learnings from that?
Yeah, so actually, I really put it down to my upbringing as well. So I was raised in a family where we spoke very openly about financial matters. They didn't insulate us in any way when they were planning, since we were kids, when they were planning to send us to university, how they planned their spending, how they saved, how they invested. So it became part and parcel of my growing up. So I was never really intimidated with the subject matter. And also, something that my parents did was they trumped experiential activities over material things for me since I was small. And that really changed my worldview on how I look at things, how, it was that whole seek and explore attitude. And something they also never made me feel was that I couldn't do something. And so when I wanted to pursue, my graduate degree in economics, that was something they wholeheartedly encouraged. But also not as much as they sent me to university, they also mandated that I save, that they mandated that I actually get involved, that I was part of the financial ecosystem, that I learned, that I pushed the boundaries, and I wasn't fearful to be part of that. I think honestly, I put a lot down to my upbringing. So if you are young and if you feel that, that there is no better time to start than now, and I know that this has been echoed right through today's conversation, I can't say that enough. You really need to start now. And so that there won't be pressure when it comes to the time where you need to make those capital investments, when you want to be in some partnership arrangement and you have to, think of the other, times where you will have to make a lot of expenditure. And also another thing is, I think what I would put in the forefront of this journey is financial planning. I think that is something that, again, there is no date to start this journey. It is today. You have to like view your life in different chapters and see what would you want your life to be? What would this phase of life be? And how can I get there? And really, it's really important to understand and differentiate your wants and needs, and keep track of your expenses. And now there's so many ways of tracking these expenses. The more aware you are of where your money is going, you can be conscious about it, and you can draw on the patterns, and you can know when to cut down, when to cut back, when it's a simple cash flow budgeting exercise. So you don't have to go for more grandeur things like, you can start with an Excel or a notepad, or even go to the apps that, from the banking sector to First Capital, you all have ways and means where you can track your spending pattern. And the moment you have visibility to your spending pattern, you're able to optimize it. And I think that is the first step in this journey. And I know at different junctures you don't think it's important, but there is something, a concept called, you need to really think of your retirement as well, that we are living longer, so we can't be, as women, we are generally the caregivers, and we're very time poor. So but the thing is, there's a lot that is available at the moment that you can lean on. You can lean on your peer group. You can come into forums like this. You can speak to your bank. You can speak to your portfolio managers. There is an ecosystem that is there at the moment to support women. And I think it's important to leverage on that and to really not think of it as this daunting aspect, the daunting topic, so to say, to delve into. So in terms of my journey, I think I would think I was pushed to the deep end from the very beginning. I was told to take chances, and even my journey, I've made some very bad decisions along the way, but they were my decisions to make, and I learned from it. And one thing I do think that was important to me also was financial independence. And the moment it became my decisions, and there was my skin was in the game, so I needed to learn. I needed to be abreast. I needed to talk to people. I needed to push myself to understand what else was out there, because I was actually I was going to suffer the repercussions if not. So that was my story.
Thank you. And we looked at this before, and we spoke of how women tend to play it safer, and and are a little more risk averse because we are careful, because we want to make sure we don't lose out, or funds don't get lost out, and those depending on it don't get left high and dry. But really, what do the two of you think? Do you really think that women do really tend to play it safer when it comes to money? And how do you think this might affect things like savings, investing, and wealth building? I would maybe ask Inoshini if you could what your
Yeah.
thoughts might be on that.
So I think women as a whole, I think we are risk averse in general. We make, very cautious decisions for the most part. But I think this is also where we're falling into that trap. When we think we don't know a lot, or we know a little, we don't want to go into that territory. And then we keep away from it completely. And so because I think another thing that happens is, because of various reasons, we have to come out of employment. We are the main caregivers. There's a double burden. We 85% of unpaid work in Sri Lanka carried out by the women. That is, whether it's childbearing, whether it's taking care of the elderly, whether it's washing, cooking. So that also stops women from being actively participating in economic activities, or even having the mind space to get on top of financial activities, right? So that also stops them inherently from going into a territory that could have implications on you. And also, they don't want to take the risk of taking the accountability of their decisions having a negative impact on their family, on themselves, on how that would be. And that sense of fear is ingrained to us from a very young age. And I don't know whether it is more so in Sri Lanka, whether we're told always to win, that when we do something, we have to do it well, and we don't have that risk taking attitude almost. And that is why, even as you mentioned, there's only 35% of females in the labor force participation, when the global average is at 47, and of which only 25% are actually in proper financial space as well, which means that it's an area that we're straying away from for inherent reasons. So maybe it is very much in our DNA, which we need, I think, to kind of address from a very young age. So even if it is not us, it could be the next generation that we try to amend this, or to cut that vicious loop in. And also another thing that I think stops women from investing or getting into this space is also looking at risk in a very linear binary form. I think over the years, what has happened is, through competition, through technology, there are lots of products out there that have bridged this gap, that it's no longer equity is risky, debt is, safe, savings and FDs are the safest option. There's now so many blended products that have come to the market. And what competition has done is that they've actually made products that the consumers want. So it is actually consumers are on a winning wicket, so to say, because there are more options to mitigate your risk and still have a high return if you're on the ball. You have to watch the space. I think that's coming back to what Rashmi was saying about passive investing and passively putting it in an FD and keeping it there, hoping it'll grow. It's also that wealth building mentality, right? Because once it's kept there, yes, sure, it'll grow, but like you showed in your presentations, it won't grow as much as if you actively took part and took the very tools that you're offering from First Capital to grow it 3.5x times. So it is all about being real, going deeper and thorough into the options, seeing what is out there. Look at all the ones that the bank's offering. All of them now have apps. They all have WhatsApp channels. They have people they put forth through their branch networks to talk to you. There are webinars and seminars like this. Just get to know products beyond your plain vanilla sort of products, because there are so many out there that actually blends in at different stages of your life. You can move things around. So what that then brings me back to the fact that there's, even with less risk, you are able to get a higher return. So you don't have to have that whole, high risk, low return. High risk, high return. That sort of trade-off doesn't necessarily need to exist when you need to be in this space, so to say. So what I would encourage is, I think, to get more information, get more financial savvy, start leaning in on AI products, start leaning in on, there's so much content out there, and very digestible content in Sinhalese, in Tamil. Just need to go and just type in financial management and give in all your inputs of where you want to be, how you want to be, and what you have at the moment. And you'll be surprised at what you have, because what you get is a plan, and that can be your starting point. So no longer is your start line so further out that you need to be so risk averse to keep yourself out of the game.
Sure. Thank you, Inoshini. Just sort of in drawing this to a close of sorts, before we drop off, I just want to quickly touch on, and maybe my next question is to Rashmi in closing, but just to kind of, I know Rashmi, you touched on your journey, and you said you were going to tell us about what, share some more info on your journey and the things that, maybe backfired, or, which you feel like in hindsight you could have done differently. So just to sort of touch on what that part of your experience looked like, and what wisdom you'd like to leave with us.
Yeah. So I'll try to keep it short. I can share what I'm good at, I think, and these are all, again, things you learn on this journey. No journey looks the same. I think what I have been good at is taking a more long-term view of what my financial goals are, what I want it to look like. And that's not that easy, and I don't think it comes naturally. You have to actually sit down and think about what you want it to look like, which I think, again, is not something you learn, but thankfully I had somewhat of a discipline to do that. I was also not really afraid to make choices that maybe others would have considered, say, risky, but I will do the research and periodically reevaluate those decisions and choices. Now I'll tell you what I really struggled at and was particularly bad at. I was really bad at the more day-to-day financial discipline when I started working. I was quite bad at tracking my expenses, which, those sound really basic, but we all have our, Achilles heels, and thankfully I was able to course correct this in my 20s itself. My partner was much better at it. But again, this financial discipline is so important. If you don't know what you're spending, you can't save, and then if you can't save, you can't invest. So developing this discipline, which again sounds quite basic, I'm sure other people do this really well, but I had to consciously develop this the hard way, because it wasn't something that came to me naturally. um, but again, I think for those others who may be actually doing this well, another person's challenge might be that they don't actually have the knowledge and skills on where to invest your money in a prudent way. So I would just say identify, where your weaknesses are early on, and I think use it. Don't be afraid of it. And I think just in terms of, just overall things that I think worked well for me is to really be active. I can't reiterate this more. Don't leave it for somebody else. This is your financial security. You have to own it. All of the decisions, the habits, the research. Start with, again, think through about what are your goals. What do you want? I was listening to a podcast which is not about finance but about more life, um, situations, and the podcast was doing it. What he said is, we're really bad as humans about articulating what is it that we want from life, from our financial, security. We can't define it, or we can't, articulate it. For example, do you want to get rid of the debt that's hanging over your head? Do you want to build your wealth for your retirement? At whatever stage you're at right now, is it to build out for your kids' education? Really think this through, what your goals are. And then I would say, look at your current financial situation. Whatever you have done in the past, just take a stock measure of where it is today. Know what your income and expenses are. Track it on a monthly basis. This can really help you to determine, how much you can actually save. And then if you think, okay, what you're actually able to save today is really not great, then look at your lifestyle, look at your expenses. Are you, having a very high base of expenses on a month to month basis? Do you need to make certain cuts in your expenses? Are you also maybe over levered? Have you taken on a lot of debt? Is it in, credit card debt? Again, this depends on every person. Like, some people, I think, sometimes get into like more credit card debt. Before they know it, it's become a mountain of debt. And I think take those one at a time. If you have a lot of debt, try and get it under a manageable level, so that, then you can get into more saving and then again investing. But figure out what your situation is today. Then I would say, really educate yourself. You have to do the research, and I think this is actually something we are good at. I mean, even if you're looking for a doctor, we, if it's some ailment, I think almost, do the research so that we can even ask questions from the doctor. Or if you're planning a trip, we are good at doing that research. So I would say, really apply it here, because we do it in other matters, but I don't think we do it here. And then I would say, just start with basics. Once you have at least some understanding of how you want to invest, um, look at those different investment options. Look at where you have actually invested. So if your investments are only in savings and fixed deposits, that tells you what you're actually looking at, right? Like, there are investment calculators, etc., that are online, that will tell you, if you have this much of money to start with, and this is the rate of return you're getting, in another 20 years time, what are you going to be left with? And if that return were to change from, say, 8% to a 15%, you're looking at a very different, wealth that's going to get built out over time. I would say, just try doing that for yourself, and then get a better understanding of, how, um, investing in the capital markets work. Or if, that seems too much of a stretch, then there are other vehicles like unit trusts, or, if you want to then diversify, and all your money is, in, say, more financial assets, do you want to also maybe diversify where you can also hedge against inflation? So there are a lot of ways you could do it. And I think, start saving first. If you haven't still started saving, start small, investing, and then I think gradually diversify. And I think one thing, most of the time why people also stay away from investing, whether it's a capital markets, etc., is because it's such a long term thing. And I think we're not used to that. We are always used to the more, I think the longest horizon we can take is like a 5 year fixed deposit kind of a horizon. Anything beyond a 5 years, like say a 20-year horizon, is not something we are very used to. But if you can adopt such a long term view, if you're 25 today, or 30 today, or 35 or 40, you can take a 20-year view, right? It's not, you shouldn't shy away from that. And then being patient, news cycles will feed a lot of, doom news cycles and say, oh my gosh, the market is dropping, or, but it's business cycles will always, correct in the long run. So if you prudently invest, you can make it's not just about making money, but it's really about building that wealth in the long run that gives you that financial security. And then having the discipline, this is the real key as well. Most of us start, we have done the goals and the plans, we've talked to advisors, then we've started, and then after a couple of months we stop doing it. Regularly contributing and checking where we are, whether we are meeting or keeping up with what we originally set out to do is key. I always see this statement, discipline trumps motivation. Initially I didn't really understand. I was like, really? But it's true, right? If you really want something to work, discipline is the key. Having big ideas or goals doesn't really matter if you don't have the discipline to, track it regularly, track your expenses regularly. And I think finally I would say is just whatever you've done or you're doing right now, it's always good to periodically take stock and reassess, because like I said earlier, the economy, all these things like inflation, they're very dynamic indicators. They're constantly changing, so you do have to keep an eye on your investments, and then if needed, realign. You can again talk to advisors, whoever your financial advisors are, and then rebalance if needed. And to just even get you started, always talking to an advisor, a financial advisor, is helpful if you don't have, if your expertise isn't necessarily in this area. But regardless of whether you get a financial advisor or not, do your own research so that you are also making an informed decision with the advice. But last thing is to just always check your biases. And this is something I try to do as well. If we are staying away from a particular, say, asset class or certain investments or whatever, is it because we have actually done the research, or we just going by a gut feeling or a bias, or because somebody said so? Is really not the way to go. So always check your biases, and just take ownership. Don't be passive about this. It's really about securing your freedom, and hopefully to make sure your life looks like what you want it to look like in another 20 years, hopefully. With that, I'll pause there, Deshani.
Thank you, Rashmi. Thank you so much. Yes, lots of wisdom there, and I hope some of you took away a few things, as did I. I have a question for Inoshini. Actually, this is from the audience we have with us this afternoon. It says, "How old were you when you made your first investment, and what was it? Did you wait until you were more stabilized with your life plans before you started really saving?"
No, the answer is no. I didn't wait till I was stabilized. It was way before that I started. My first investment, I think, was a unit trust investment, but then I quickly moved on to equities as well, just because I loved doing research at that time. I was a student, I was a university student, and I was working part-time. And I thought, the little money I have, I can actually grow it. And I realized the best way according to my risk file, I was like, okay, I can grow it if I actively invest it at that time it was I think it was a unit trust that I first invested. And it was just great to see how it was trading, what were the inputs for it, what the unit trust had invested. So it again made me want to learn more about how it was getting calculated, why it was, why they were investing in certain things. And so I started reading up more and more, and then started then again researching on what the other providers were giving, and then comparing and contrasting. And from an early stage in life, I started actually actively managing my finances. And I think that's what I again want to reiterate here. I think there is no better time to start than as early as possible. Start small. There is no quantum restriction, right? Just start small and see it go, because then it's a feedback mechanism. You get more confidence as you do it. And that whole aspect of really thinking and taking the time to consciously think of what you want, the next stage to be like, and how you can get there, and to really have transparency into your expenditures, your savings, investments. That is super important. Once it becomes part of your mindset and it's part of your ecosystem, that's what you do automatically. It doesn't become effort. It doesn't become like, oh, I must sit down and do this. I will, then it doesn't get parked aside, because you're anyway in touch with the realities of your revenue, to your expenditures, to your investment portfolio. It goes in tandem, and it's something you take on, in that same merit. So I think it is also be conscious about it, and prioritizing it is what is important. And I certainly didn't wait till life got more stable, and so the pressure was off, I suppose, when it was time to make investments, or time to make those calls where where you will have demands on your money, where you will have fixed things that you have to take on board. But by then you're working with a different pot, so to say, only because you've grown it. But that also makes you more because it's what you've grown with your own hard work, with even just monitoring, just seeing it grow. You're so much part of it. So there is a sense of getting close to that. So the decisions you make are more thought out. And yeah, so that's what I would say.
Thank you. And I think a lot of people think about, how does, we look at investing and look at our funds in relation to life cycle, right? I mean, what one would do when they're single and studying and free, and, no responsibility is very different to what you do later on. In your opinion, how do you think this would change? Do you stop investing after a certain point because you don't want anything to happen to this money? Or what do you say? Or do you say that it's a bigger need to actually really look at it?
I think that it's a continuous process. I think with investing, once you start, you realize that regardless of the goal, yes, maybe the way you shift between your investment portfolios will be determined depending on what kind of cash flows are imminent and things like that, and how you balance it out. But in regards to the process of investing, I think it's a lifelong journey. And I think it's even more because we don't know what is ahead. We don't know. I know that change is the most permanent thing in life. And you don't know what is around the corner. You want to be able to withstand the curveballs. You want to be in a place where you have that financial security, that you don't have to be pressured to make decisions that are suboptimal. And sometimes it is also about being so active that, even take, for instance, credit cards, right? You can actually use credit cards, and if you really use it well, you don't have any negative implications. You're actually doing exactly what the banks don't want you to do, but you're managing your working capital cycles. So it is about that. That's the thing. What I would say with investing and this whole journey, it is so rewarding when you're on top of the game. And to be on top of the game, you really need to be disciplined and carve out some time to watch that space. And when I say watch the space, it's like your savings. The global standard is like you saved or invest 20% of your earnings, and that is something that you do from get-go. It's not, you don't think of it, okay, when it is time to be in a partnered relationship, when your children's expenses come in, when you have to buy cars. That's not what you do. I've heard a lot of, in a lot of cases, okay, I'm putting money to my mortgage and then afterwards that asset will be mine. And there is no saving on top of it. Yes, at the end of it, the asset will be yours. But there's another thought school that'll think, okay, you still need your recurring cash. You need to have liquid cash available as well. So that can be the portion that you save on top of, setting money aside for your mortgage. So once it becomes part and parcel, once you take all your expenditures and still save or invest a portion, it becomes part of your nature. And then you will curb your expenses accordingly. You will then really take a deep dive and differentiate between what is this really required? Is this a want or a need? And plan it out and make compromises, because you can't satiate every single want of yours, no? And so you have to make compromises at a certain point to be able to build a good enough portfolio so that you'll be not jittery enough, and you can kind of take a step back, but not take the foot off the pedal completely. Sure, you can, as the living standards improve, you want to, reward yourself, you will have some leeway to do that, but that will come along the way. That is part of the reward of the system. And I think the more I feel like a cycle. When you get good at it, the more you dabble in it, the more good you'll get at doing it. So it's the experience, it's seeing the trends, seeing the, different cycles, seeing what will move, getting the sense of the market sentiment, having a close relationship with your financial advisors, having an eye on your expenditure is super important, being conscientious about it, the moment it's transparent, you understand where you're going wrong, and you really take, stock takes along the way.
Thank you so much. I think we're almost at the end of this, but if I were to ask both of you, in case someone wasn't listening to any of this and they had just one takeaway from something you want them to leave with today, Rashmi, what would you say that would be? Just one key takeaway from your end.
Be active.
Yeah.
My
Okay.
main thing would be active, not to be passive about this. It's too important, whether it's for yourself, for your kids, for other dependents, for family members. It's far too important to leave it to chance or for somebody else. Be active and just, and then start with the basics, right? So my main thing would be to just be active. Don't leave it to anybody else.
Inoshini, how about you?
I would say start now and start small. I think don't get deterred by the quantum. Start with the smallest bit you have and invest that, and prioritize wealth creation. I think wealth creation should be on top of the mind at all times.
Yeah. Thank you so much to you, Rashmi and Inoshini. Basically, as we wrap up today's session, we've looked at a lot of things. We looked at 3 main steps that we think might be good for you to leave as being a better investor. And if you really want to look at this and take it forward, take your investment journey forward, and we heard so much of what Rashmi and Inoshini had to say. We spoke about building your investment, leaving a legacy behind, and wealth creation. Talk to us if you want to take this forward. Talk to First Capital. Please feel free to reach out to us on 0112-651-651, or visit our website www.firstcapital.lk. I really want to thank Rashmi and Inoshini this afternoon for taking your time. I know you have a lot on your plate as well, but thank you so much for contributing to this discussion, adding value, and hopefully leaving behind a set of much better investors today. And so sorry, Rashmi.
Sorry, I just wanted to thank you for inviting us and for the opportunity to talk today. Thanks again, Deshani.
Thank you. It was our pleasure.
Thank you,
and
thank you,
thank
First
you.
Capital, for the opportunity. It was good to be here.
And as we've emphasized, FinPower is not just a statement. It's not something we'd like to just do once a year and forget about. Really, it is, championing change and championing female financial empowerment, something we believe in very strongly. And thank you to all of you, the audience today. I mean, you've joined because you believe in this. Rashmi, Inoshini, thank you so much. And all of you playing a vital role in this effort. Thank you all for watching us and joining us here this afternoon. Uh, be keep tabs on this channel, and we have a couple of more webinars that are coming up. We have the Tamil one coming up on Wednesday. We have the Sinhala one on Friday, and that too should be interesting. So we look forward to seeing you there. And until then, take care and stay empowered. Thank you so much for being with us this afternoon.